Welcome to Market Overtime. I'm Diane King Hall here on the floor of the New York Stock Exchange. There's more noise than ever within the markets, with volatility already a hallmark of 2025. Dave Butler, the co-CEO of Dimensional Fund Advisor, says tune out the noise. That happens to be the title of Dimensional's new documentary, which looks at the birth of modern finance and explores efficient market theory and beyond. Dave joins us now in this episode of Market Overtime. Dave, thank you so much for joining us
Diane.
Today. All right. Before we dive into the film and all of that, I feel like you have a unique background that our viewers need to know about. You were a professional basketball player once upon a time, so tell us about that and the transition to finance.
Well, I started at California, Berkeley, played basketball there for 5 years, and then I got drafted by the Celtics. So we're in New York town here, but Boston Celtics.
Say that quietly.
Say that quietly. And the year I came out, they had a strike, so I ended up going overseas. Played my first year in Istanbul, Turkey, played another year in Japan. I went back and finished up my MBA at Cal. And then went over to England for my last run at basketball. And I think probably 3 months into the season, I had torn up my Achilles a year before and had some injury issues. And I had gotten a phone call from a big investment bank here in New York and said, we wanted to come back to New York. So my story people always ask, how long was the transition from basketball to professional life? And I always tell them it's about 24 hours because I got the phone call. I flew back to New York on a Sunday afternoon. My younger brother Greg played with the Knicks, so he was playing there at the time. He's a 7-footer. Yeah. So I went to his apartment, borrowed a suit, which was a little baggy on me. I'm about 6'8", he's 7 feet.
Close enough.
Close enough. Baggy suit first day. Walked into the office. Went home that night, bought a couple more suits, and that was the start of my career.
Okay, that was the start of your career. But it's interesting. So, I watched the documentary, and you come up later in the documentary. In terms of you yes, you started out in finance, but it feels like there was a brief crossroads where you were thinking about leaving and going into teaching, correct?
Yeah, exactly. I was 4 years into my career, and, like we all have those aha moments, or kind of the reflection moments, if you will, where you just don't feel right. You don't feel like it's the right direction you want to go. And so I had made a decision at that time to move back to California, become a high school teacher and a basketball coach. And fortunately enough, as I was sitting at the desk here in New York, I looked in the Wall Street Journal, 17th page, bottom right corner, and said money manager, Santa Monica, California. And I like those 3 words, Santa Monica, California. So I sent a resume in. It turned out it was Dimensional, and I went out there over Christmas break, interviewed with a number of folks, including a Nobel Prize winner, Merton Miller. I came away just super impressed and felt like that was a direction for my career that I wanted to take, and I could spend, I thought at the time, 10 years in this new role, and here I am 30 years later in the same company, different role, but same company, and it's been a great career.
So let me ask you this, because in terms of your personal life, it feels like a couple of these moments were, we'll call them random. But I feel like the premise of the documentary sends the message that, when it comes to the markets, nothing is random, right? You all explore the efficient market hypothesis, and it sounds like you all are big believers in that. What's the message that you all are trying to get across and tune out the noise?
Well, I think it really starts with this idea of how do the capital markets function, and do prices reflect information? Are markets efficient in terms of integrating that information into the pricing mechanism? And our view is that it is. And when you look at the film, it goes back to the 1960s, and a lot of the academics who were in that space at the time started to look at data. They started to get their hands on big computers. And they started recognizing that there really wasn't a whole lot of an ability to outperform the market. So the market as an information processing machine was really, really good. And it made it difficult for active management or stock picking kind of activities to outperform that market. So that was really the basis for what we would consider the index revolution. That started in the 1970s. And indexing was this concept that you could buy the market. You could buy every stock, you could be diversified, you could be low cost, and you could be tax efficient. And that would be a good solution in terms of deploying your capital in the capital markets.
So the past 2 years, honestly, that proved to be true, right? If you go back to 2024, 2023, obviously beyond that, there is more evidence of that as well. This year, there are so many voices that we talk to that say it's the stock pickers market in 2025. And given the volatility, it kind of feels like that, but I don't think you would agree with that, I would guess.
No, I think we recognize, and this is where the second part of the movie talks about financial advice and discipline in markets, and oftentimes when you look at the history of advice, it was really, in my mind, built around human emotion. So fear and greed being two big human emotions that we've had to deal with. And I think the investment advice industry was built around that. So I would, either talk about the economy, I would talk about the direction of inflation, I'd talk about a certain stock, and I would get you interested enough to have you transact. And so that was really the basis of advice, 30 years ago when I started. And that advice then led to transactions, it led to high commissions, it led to high transaction costs, it led to high taxes, and that was sort of the model back in those days. So where we've kind of progressed to, I think, is we have this view in the capital markets, low cost, diversification, tax efficiency, and then if we can couple that with good holistic wealth advice and having advisors help clients stay in the market, stay disciplined, tune out the noise, if you will. There is always a lot of noise. I've been in the market for 30 years now, 30 plus years, and there's never a year or never a month where there isn't something in the news, and that's the question for most investors is how do you react to that news? And I always like to say, I'm aware of the news, but God forbid I ever try to invest my portfolio based upon that news. I base my portfolio investments on a long-term, disciplined view of the markets, and I try to avoid and tune out the noise as best I can.
Behavior, though, is sometimes hard to, because as much as people want to tune out the noise, sometimes there's a behavior component that comes into play. How do you kind of manage around that?
Yeah, it's very, very hard, and people ask me that question all the time. I've been in the market, I'm a co-CEO of a big investment company, and I still have those emotions. So we never tell people that you're going to get rid of those emotions completely. The question again is, how do you react to those emotions? So you can look at the kind of information that comes out in the newspaper, you can read the newspaper, you can be very knowledgeable about what's going on in the markets in the world, but you need to separate that from how you actually invest your portfolio. So again, coming back to the advice part and the advisor part, the advisors, in a lot of cases, they're one of their big roles. They do many things. So they work on estate plans and tax plans and charitable giving and so forth. But a big part of their role is discipline and getting a client comfortable with their allocation, with their investment policy statement, and how that investment is going to be disciplined and stay in the markets over time. If clients can do that, they're going to have a great chance of a great investment experience. The hard part, and what I've seen over time, is people have a hard time mentally knocking out the noise and staying in the market.
Because it makes me think of Morgan Housel's book, The Psychology of Money. I don't know if you ever read that, but what I found that was interesting that came up in there is, yes, obviously there's something to be said for index investing and all the, information that you receive and the academics of it all. But oftentimes at the core of how someone kind of grows up, there's this money philosophy they have, coming from their household, for instance. And you all had one subject, one interviewee who had a windfall, and so I'm sure you've come into contact with people who've had a windfall, and their proximity to money is going to be different because this is new to them. So they are going to have some emotion around it, and how do you deal with that? A newly minted investor with a windfall.
Yeah, well, Gene Fama always says, show them the data. And if you can show them the information and the research on how markets work and why they work the way they do, sometimes that's helpful from an educational perspective. But we have a saying that the market hands out big tuition bills, and sometimes, unfortunately, like the person in the movie who lost that windfall initially, he had to go learn for himself, and that happens sometimes. So what we're trying to do is trying to catch people early in their investing career, give them as much education and information as they can absorb, and hopefully that gives them a nice basis to be able to not make the mistakes that we've all made. I made those kind of mistakes.
I remember you talked, I think it was you who talked about one mistake. Was it the Boston
chicken?
Yeah, tell us that story.
Well, I was a Wall Street guy, and I thought I knew a lot, and I had a system that it was called CAN-SLIM, that was the acronym, and I had made a number of individual stock bets over the course of a year, and I was 8-0. I'd won eight times. I had made money in 8 different stocks, and so I decided that the last stock was called Boston Chicken, and I thought that was a good investment, and so I loaded up. I can't remember the exact number.
I think you said it was like half of your net worth at the time. It may have been more. I feel like it was at least half of your net worth.
It was at least half my net worth, which I'd hate to even admit now. But I put half my net worth on one stock, which just destroys everything that we know and we learn.
Yeah.
But again, markets give you those tuition bills. So I put my money in the market. The analyst said that it was going to go to 27, and looked up my stock and went down A's, B's, found Boston Chicken. Looked over Boston Chicken and it said 7. And I was like, I literally had a heart attack. But then I had a moment of clarity. I thought, well, I saw a crease in the paper, so I thought maybe there was a 1 inside that crease.
Yes.
There wasn't. It was down to 7. So I basically lost half my investment in that one. And that was one of those where, again, I think, when you have that moment where, I call it an aha moment, it sort of made me back up and reflect on some of those things I had read and seen, but I almost didn't really want to understand them until it actually happened to me. And that was right at the year before, actually about 3 months before I'd actually gone out and had that interview in Santa Monica. So, as you said, sometimes things happen for a reason and we don't know why. And I had this really negative experience in the stock market. Then 3 months later, I had these conversations with these Nobel Prize winners, and it just was an aha moment for me.
But I wonder, though, also if the emotion of that moment kind of contributed to where you are now and your view on the efficient market hypothesis.
Yeah, absolutely it did. I think I took courses in college and during my MBA that we talked a bit about the efficient market theory, and we talked about how capital markets work. But I have to
It was just theory to you.
It was theory, and I didn't really pay much attention. And I took a couple statistics classes, and those were sort of interesting. And I think actually having that real life experience then allowed me to actually open up my mind to reflect back on what I had heard, and it made me think that there's got to be a better way. And so I just had that moment that we all hope we have in our lives, where we, again, I call it the aha moment, and I heard these stories about not only how to invest in the capital markets, but then also how an investment advice should be given. And the coupling of those two really then led to this great investor experience. And so when I heard that story, 30 years ago, I ran home and told my parents, I think I found something I can really get behind. I think I can do this for 10 years. And again, here it is 30 years later.
So one of the things I want to ask you about, there was a voice in this documentary, I don't know how exactly to pronounce her name, Savina Rizova, and she talked about this, there was a question that came up, separating signal from noise, and she said many people underestimate the noise in financial markets. Markets are unpredictable. Hopefully more people understand the magnitude of uncertainty and as a result change their ways. Do you know what she meant by that?
Yeah, Savina's a much smarter person than I am, so I usually try to back off and let the academics do their business. But what I try to do is try to take some of that information and then explain it in a way that's digestible for my mom or your dad or something like that. I think when Savina talks about that, academics take a long time to really get to a conclusion that they would say is significant. And I've heard different academics through the years. Gene Fama often talks about that when people would say, well, what about so-and-so manager? They just beat their benchmark for the last 3 years.
I was going to ask something like that because there are instances where we know about that.
Yeah.
Is that just, kind of a random one-off in your view?
Yeah, it takes you back to your statistics class. So there's got to be a significance level for anything before you actually are confident as an academic that significance level suggests that is a true statement. And I won't get into all the
So is it just
math.
luck? Is that the view?
It can be. It just takes a long time to prove it. You don't know if it's luck or if it's not luck. So if somebody has a track record of a 3-year track record of outperformance, depending on the size of that outperformance and depending on the volatility of that outperformance, it takes some time to actually recognize that performance is actually skill or luck. And so it's a long, long time before you can do that. Even in the equity markets, when we talk about the equity premium over a T-bill, say it's 4 or 5% historically. It takes 10, 15, 20 years with the volatility around that 4% to get to the point where you can confidently say that is a premium for equities. And oftentimes
and that it's worth it.
And it's worth it. But this comes back to the behavioral part. You have to have the ability
to ride it out.
To ride it out, be confident that the premium is there, and then ride it out over time. When I first started, I think it was 1966 to 1982, there was no equity premium. So equities.
You didn't start in '66.
No, but I was born before that.
Okay, go ahead.
But I remember looking at that data when I first started Dimensional, and there was a 16-year period where equities underperformed a T-bill. And so anybody that assumes you just put my money in the equity stock market,
yes, go ahead.
It's a phase. So it's those kinds of moments make you recognize that all of these premiums, all of the performance of the stock markets, they have a big tail in terms of kind of how volatile they are. And so you have to recognize that, and oftentimes for us, we explain that early on. We don't say the stock market's going to give you beat a T-bill. We say the stock market historically has beaten a T-bill, but there's a large volatility around that performance. So you have to be able to be prepared to go through potentially a 16-year period where that equity premium might not be there. So the educational part is really important.
So talk to me a little bit about the importance of this film in today's day and age, especially, I know you said that it's true, every year there's something else that can kind of cause a hair trigger response. Recently, it's about tariffs. We've been here before, though, with regard to kind of tariff influence. What is the goal that you're trying to achieve with Tune Out the Noise?
Yeah, I think the goal of the movie is that there's these really hard concepts to understand that are statistics and data oriented. And our question has always been, how do we take that information, really powerful information, and make it digestible?
Right.
And David Booth and I sit around and talk about this all the time, and we use my mom.
I liked him a lot.
Butler's mom is what we use as our kind of a metric. So my mom, God bless her, she's not a finance person, but she's a people's person, and she understands stories of people, and she gets interested in that. And so I think for us, the movie was sort of how do you take a really important, powerful story in the capital markets and investing, and put some people stories around it, so that somebody like my mom might actually engage in the movie, and then hopefully engage in the concepts, and maybe that affects them as an investor.
It's so funny that you bring that up. It's not just people who may not understand that, because the other thing we talked about is like just the psychology of money. So for a person like myself, or who's in and around it, there's still feelings and behaviors that come into play that you have to rework a muscle around. I'm not even going to go into my own mistakes. We all make mistakes. And then David said something that stood out to me. Several things, but at its core, people want to improve their lot in life. So that's why, to me, you probably have the stock pickers or the active money managers, et cetera, like where they're trying to beat the index, et cetera. But I want to go to you all's strategy. It's not so much index investing. There was a word that came across, tilting, in the film. Tell me what that's about.
Well, Dimensional, when you go back on the history, the folks in the movie are the people that actually started the index revolution. So they started the first index funds in the 70s. They started Dimensional in 1981 with a micro cap or small cap portfolio.
Yes, I noticed there was a lot on small caps.
Yeah, so that's the dimension idea. So what Dimensional tries to do is we start with, what are all the great things about indexing? Indexing is low cost, we're low cost. Indexing is diversification, we're diversified. Indexing is tax efficient, we're tax efficient. The problem with indexing is you actually have to mimic a benchmark, and that causes problems that come with trading and moving stocks in and out of the portfolio. And
what are the problems that you're trying to address?
There's things like, call it reconstitution, for lack of a better term. Yep. So on June 30th, the Russell 2000 reconstitutes their portfolio. All the stocks have gotten bigger, go out of the index. When the stocks get smaller, they go out of the index as well. So there's a lot of pressure on that particular date on stock prices and spreads, because there's a lot of volume that's happening in that particular day. So one of the things that we do is we don't try to mimic a benchmark. We don't try to trade on June 30th. we've traded throughout the year. We trade on a
You
daily
avoid the
basis.
volatility.
Daily implementation. So we try to capture areas of the market in the most efficient way that we can. And to your question about tilting, again, going back to the academics, there's academic work and research on certain premiums in the market. So there's the equity premium we just spoke about. There's a size or small cap premium. There's also a value premium. And just recently, the profitability premium came around. So it's sort of getting I'll call the telescope a little bit more refined, and finding parts of the market where we think there is a premium, and then narrowing our portfolios into those premiums and doing it efficiently and capturing it in a really efficient way trading-wise.
So you talked about these aha moments, and different people had them throughout Tune Out the Noise within the evolution of modern finance. Do you still have those moments, especially when we have such a fast-moving world in terms of technology and where generative AI is now?
Yeah, I think so. You just have to keep your eyes open at all times. I mean, one of the great things about Dimensional is, as I said, there's a lot of smart people running around there, so I've never been bored by learning something new or knowledge. But even in the movie, I don't know if you remember, Roger Ibbotson said, he talked about the rule of 7.
Mm-hmm. Yeah.
And that was kind of one of those where my oldest son is 22, and I was talking to him about investing and how should you invest, and I brought up this rule of 7 and said, look, if you had $100,000 when you're 22, by the time you're 65, that turns into about a $6.5 million if the rule of 7, which is a 10% return per year, stands up. And that sort of caught his attention, because he's like, that number's a pretty good number, and it's a number people could retire on very easily. So things like that, will come across, and usually I'd say it's a lot of the kind of anecdotal stories, communication things that kind of catch my attention. That one particularly did just recently.
I want to go back to one thing that David said. He talked about how we've seen the democratization of finance. More people are invested, but still, when you think about it statistically, it's not as many as in theory should. And he said, but only a small number of people believe this stuff. How do you get more people to believe? Because I see things on social media, like, in the past few days, we've seen so much volatility. We saw drawdowns in equities, and I saw people commenting on social media about pulling money out of their 401k. It was clear it was early. I'm getting everything out of my 401k. How do you send the message to not do something like that?
Yeah, it's again, we talk about human emotion. It's really hard to settle greed and fear.
Yeah, it's a fear factor.
It's tough to push that down, but I think all you can do is, again, you can educate and you can train people's minds and get them to reflect on when they do those types of moves, that they pull money out of their 401k. You got to look back sometimes. We have one gentleman at Dimensional that looks at just magazine articles from 4 years ago or 7 years ago, and he said, here's the best 7 funds to buy. Here's what you should do with the market. Here was the analyst's opinion on where the market was going to be next year.
Their S&P 500 targets for the year.
And he cuts those articles out. He puts them in a file and he pulls them out 4 years later. And it turns out the experts aren't so expert, and oftentimes, again, it's not because they're not expert. They're very smart people. They have a great experience. They got great knowledge. It's this market that's so good. The market is such a powerful information processing machine that it makes it really hard for you or I to actually outguess the market. So whatever's happening in the news today, that's going to be reflected in price very, very quickly. And people, if people can get to that concept, then I think they have a better chance of staying disciplined in the market.
So I just have a couple more questions. For some people, they feel like they're late to the party and they got to get something. So, their view is, I don't have enough time to bet on this, efficient market hypothesis, or theory rather, and just put all my eggs in an index fund. They don't, have access to you all, so they're trying to find a way to, get some kind of returns. How do you deal with that? What's your message to them?
It's a conversation. It's trust. It's, I think, I had this conversation last week with an old friend of mine, played basketball with him at Cal, and he and his wife just got a settlement, and they were in that moment of this is our egg, this is our settlement, and we walked through all of this stuff. We talked about all these types of items, and one of the issues was, with the election and with the tariffs and like, should we not
should we do this?
market it?
Should we do this?
Should we do
not
this? Should we do
this?
that?
Yeah.
You know, and I think that's one of those where, you know, look, things could go down a lot tomorrow, it could not a lot next month, but you got to recognize, if you look at, again, at the data in historical long-term returns, you know, the market roughly returns about 10% a year, and it's not going to turn 10% every year because there's going to be different volatility around that 10% number. But if you can stay with it, tune out the noise, and be disciplined, you have a great shot over 10, 15, 20, 25 years to come out ahead and come out with a great investment experience. It's not easy, and it takes a professional, sometimes an advisor, to kind of keep people disciplined, or it takes a friend maybe to kind of keep their feet in the
Tell them the sky is not falling. Really quickly, you mentioned 3 tenets in the film. I'm going to let you deliver them because you'll deliver them better than me. Where you talked about, I'll say the first one, markets work.
Yeah, markets
and then
work.
What else?
Yeah, diversification is your buddy.
Yeah.
And costs matter.
Costs matter.
So those big 3 were the ones that Merton Miller, the Nobel Prize winner, said to me on my first interview. I wasn't even an employee at Dimensional, but in my first interview at Dimensional, he happened to be in town and didn't have any lunch plans, and so I got lucky enough to listen to him, a true legend, talk about those concepts. He said, if you can do those 3 things, you're going to be in a great position to have a great investment experience. I'd add the last one, which you and I have talked about, which is discipline.
Discipline,
you know,
yes.
Somehow minimizing the emotion, tune out the noise, and you can be okay.
Okay, discipline matters as well.
Yeah.
Right. All right, thank you so much, Dave.
Thanks, Diane.
All right. That's going to do it for Market Overtime. Be sure to download the Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. I'm Diane King Hall.